For thousands of years, people have looked at it and seen safety. Kings locked it in vaults. Empires fought wars for it. Families saved it for dark days. And even today, one sentence keeps circulating. When things get chaotic, buy gold. That sentence carries weight. It sounds timeless, almost unquestionable. But modern markets are not ancient history. Today, gold is not just a vault story. It is a liquidity instrument. And most people enter this market without understanding that. Think back to 2011. Silver went vertical, from around $15 to nearly $49 in a matter of months. People started believing this was a monetary revolution. Headlines everywhere. Retail investors rushing in. Forums exploding. This is just the beginning. Then what happened? Within weeks, the price was cut in half. Leverage crushed traders. Margin requirements were raised. Liquidations triggered more liquidations. The narrative of safe haven turned into a cascade of forced selling. No conspiracy was required. In a relatively small market, a tightening of margin rules and leverage positioning was enough. Now go to March 2020. The world shut down. Financial panic. Systemic fear. Many said, now gold will explode. But what was the first move? Gold dropped. Because in a liquidity crisis, investors do not act ideologically. They raise cash. They sell what they can sell. Gold is liquid, so it gets sold. It may recover later. But in the first shock, it does not behave like a fairy tale. The safe haven narrative does not protect you in the first seconds of a liquidity squeeze. Most investors do not internalize this. They believe they are buying gold. In reality, they are often buying a financial contract, an ETF, a futures position, a leveraged exposure, a structure that carries counterparty risk. Many people are not investing in gold. They are investing in a narrative. The monetary system will collapse. The dollar will die. Central banks are destroying everything. These narratives may contain elements of truth, but investment decisions based purely on ideology are fragile. If you buy an asset only because you believe the system will collapse, you are buying a scenario. If that scenario does not unfold on your timeline, your psychology cracks first. Real investing is probability management. So what should be done? First, stop worshiping gold. It is a tool. Think of it like insurance, not your entire identity, not your entire portfolio. Second, respect leverage. Either avoid it or fully understand it before using it. Without structural knowledge, leverage is simply accelerated loss. Third, understand the difference between physical ownership and paper exposure. Liquidity can be an advantage or a threat depending on the environment. Fourth, audit your psychology. Is your position based on data and structure or fear and narrative? Fear-based positions rarely survive volatility. Fifth, never build identity around an asset. I'm a gold guy. I'm anti-dollar. Identity clouds judgment. Strategy creates resilience. Gold will not save you. But used correctly, it can protect you. You cannot escape the system. The moment you trade, you're inside it. But if you understand how it operates, you stop being liquidity and start being intentional capital. The metal is not the trap. The trap is entering the game without understanding the rules. And the game is unforgiving. The real question is not whether gold will rise. The real question is whether you truly understand the structure you are participating in, or whether you are simply trusting the story. And that structure runs on leverage. Leverage magnifies movement, not just gains, risk. A 7 to 8% adverse move with 10x leverage can wipe you out. The market does not care about your conviction. It cares about your margin. When a margin call hits, your long-term thesis is irrelevant. The system liquidates you automatically. And this is where psychology takes over. When people buy gold, they often are not buying metal. They are buying a sense of control, protection against inflation, independence from the system. The feeling of being prepared. That emotional layer is powerful because uncertainty is uncomfortable. The human mind craves stability. Gold becomes a symbol of stability, but symbols are not the same as structure. When FOMO kicks in, decision-making stops being rational. If I don't buy now, I'll miss it. That thought overrides risk management. People buy strength and sell weakness. This cycle is not random. It is structural. Institutional players do not need direction. They need movement. They hedge. They write options. They construct spreads. They price volatility. Retail traders usually need one thing: price to go up, that if direction is wrong, the game ends quickly. The market does not target individuals, but it systematically removes fragile structures. Money does not disappear. It transfers. The disciplined, to the patient, to those who manage risk, to those who control leverage instead of being controlled by it. Gold is not a scam. Silver is not a scam. But believing they exist outside the financial system is a strategic mistake. Now the uncomfortable part. If gold and silver are rising this aggressively, there is a serious reason behind it. Nothing in markets expands without a driver. But most people see the headline, not the mechanism. The official narrative is convenient. Inflation is high, money is being printed, geopolitical risks are rising, investors are running to safe havens. Fine, but that's surface level. The real game is liquidity, interest rates, capital flows, and strategic positioning by large players. Central banks have been accumulating significant amounts of gold in recent years. Is that merely reserve diversification or a long-term hedge against dollar dominance? No one openly declares systemic shifts. Major players don't announce, they position. Quietly. If there is even a probability of structural change in the global monetary order, gold is the most classical insurance. Is that a conspiracy theory? Maybe, but markets are, at their core, power structures. Silver is even more dangerous. It's both a monetary metal and an industrial input. Smaller market, higher volatility. Large capital flows in, price accelerates, the narrative expands. Retail investors enter late, driven by momentum. Then liquidity pulls back, and price collapses just as fast. The cycle is simple. The most dangerous mistake is surrendering to the phrase, safe haven. Safe does not mean risk-free. Gold has spent years moving sideways. Silver has lost half its value in months. There have been long periods where both underperformed inflation. But people ignore that because the idea of safety feels comforting. Markets punish comfort. Assuming gold will rise forever because it's rising now is financial naivete. Assuming silver will keep exploding because it just did is the same mistake. The rally may be driven by macro strategy, fund positioning, even coordinated capital shifts. But no rally moves in a straight line. Like every asset, gold corrects. Like every asset, silver crashes. Like every asset, both can become overvalued. Those who enter blindly get trapped at the top. Those who use leverage get erased on the first pullback. Those who tie their entire portfolio to one narrative lose time. And time is capital. The metals may be valuable. They are not sacred. Even if a major monetary transition is underway, it will not unfold cleanly. It will be volatile, violent at times. And those unprepared will panic even inside what they call the safe haven. The issue isn't buying gold. The issue isn't buying silver. The issue is jumping in without thinking. If you don't understand the drivers, don't calculate the risk, don't define position sizing, you're not investing. You're buying a story. And in markets, the most expensive thing you can do is believe without questioning.